Thank you everyone for joining us today, wherever you're dialing in from around the world. My name is Pete Humison. I'm a research analyst here on the Kraken Intelligence team. And we're ecstatic here at Kraken to have the pleasure of chatting with Greg Di Prisco, the head of business development at the Maker Foundation. I think that today's presentation really couldn't come at a better time, given their launch of the Multi Collateral Dai this past Monday, or as I'm just recently learning too, that the community likes to call it much cooler Dai. Big milestone for Maker, let alone the DeFi industry, and we'll get into that later. I'll just give you all a little bit of background on Greg and the project before we kick off here. Greg remains a managing partner at Distributed Capital Partners. It's an investment partnership that specializes in early stage blockchain projects and distributed software. In 2016, along with a few other partners, Greg founded Ether Index, the first and only ETF in registration with the SEC to track the price of Ether. Prior to working in blockchain, Greg was a futures trader at Axiom Markets, trading a variety of commodity and financial derivatives. He does hold a degree in economics from Villanova University. And as far as the project goes, for some of those who might not be familiar with the project as others, MakerDAO is a decentralized organization dedicated to bringing financial stability and transparency to the world economy. The MakerDAO enables the creation of Dai, which is the first unbiased currency and currently a leading decentralized stablecoin. All Dai is backed by a surplus of collateral that has been individually escrowed into audited and publicly viewable Ethereum smart contracts. Additionally, there is the Maker Token, MKR, which is not only used as a payment of the stability fee on active collateralized debt positions, but it also plays a big role in the governance of the Maker platform as well. Real quick before we begin here, and I hand it off to Greg, just a quick couple of reminders. After we're done with the presentation, we're gonna have plenty of time to throw some questions Greg's way. So if you do have a question at any point during the presentation, feel free to post it in the Q&A tab at the bottom of your Zoom screen. Your question will not be visible to any other attendees, just Greg and myself. We're gonna try and get through as many of these as possible within the hour. And last but not least, just as a quick reminder here, this Kraken Insights webinar presentation is not an endorsement, recommendation, or investment advice of the Maker Foundation or the Maker or Dai tokens. Kraken does not make any recommendations on the suitability of a particular asset class, strategy, or course of action. So now that we've got that all out of the way, Greg, I'll hand it over to you and let it rip.
Thank you very much. And I just want to say thank you to everybody for joining and for your interest in the project. I am going to leave a lot of time for questions at the end, hopefully, because I have never seen people run out of questions about Maker. So let's begin. Just to give you a little overview of what I'm going to go over today, I'm going to give you a little history of the company and the team. I'm going to tell you why we're building this project. I'm passionate about it, our philosophy. I'll introduce Dai, our decentralized stablecoin. Then I'll introduce vaults, which is how Dai is created. Then I'll talk about the Maker token and that role in the system. And then more excitingly, I'll talk about what we've just launched on Monday, Multi Collateral Dai, or much cooler Dai, as was referenced. and then I'll talk a little bit about our business roadmap, which really speaks to what I do for the foundation, which is try to manage our growth strategy. So let me give you a little history about Maker. Most people don't know this fun fact, but Maker was actually not launched on Ethereum technically. I mean, the first product Dai was launched on Ethereum, but Maker comes out of a previous blockchain called BitShares. And that actually has a lot to do with its philosophy, but I'll get to that in a later slide. Our founder, Rune Christensen, is Danish. And because of that, we are technically headquartered in Copenhagen. When I joined the team, as was referenced, I was a futures trader, and then I kind of stumbled into the blockchain space by trying to launch regulated products. Of course, those are still in registration, but we started a venture fund that was putting money into early stage crypto projects. At the time, there was only about 5, so Maker was our core position, and we kind of fell down the rabbit hole, and now all the partners from that company worked full-time at the Maker Foundation at some point. But when we joined, there was only about 10 core developers and a couple business people. And now we have 105 employees in 7 cities across 4 continents. And this is where I just want to distinguish between MakerDAO and the Maker Foundation. The DAO is the decentralized organization that the Maker holders run. this is what runs our entire system. This is what outputs DAI. This is what controls debt. The Maker Foundation doesn't have control over any of that. It's completely decentralized in the hands of the Maker holders, and any tokens that the foundation owns do not vote in that system. The foundation simply provides the software for the DAO to exist. Okay, so here's where we need to get into a little bit of philosophy to understand why Maker even needs to exist in the first place. So like most of you, I was an early Bitcoin enthusiast. You know, if you read Satoshi's white paper, one of the first lines said that he was trying to build better peer-to-peer cash. And I think that over the years, we really haven't scrutinized this statement enough. So I'll throw out better because that's subjective, but let's look at peer-to-peer cash. By creating the blockchain, Satoshi let us have peer-to-peer, meaning that you were able to extract financial intermediaries from value transactions. This was huge, obviously. This had a tremendous impact on the world, and we're seeing that today. And I think nobody will doubt that Bitcoin is an incredible asset. But at the Maker Foundation, we always believed that it fell short of producing true cash, because cash is just a pseudonym for money, and money has very specific properties that need to be met. And you know, in that context, we believe in the credit theory of money. So this is the idea that, you know, Bitcoin gains its value from scarcity, but anything that gains its value strictly from scarcity and doesn't manage its supply can never be stable. And stability is one of the core functions of money. So, you know, we had to figure out a way to create real money on a blockchain. And in doing so, over the, you know, we're 5 years old now. Over the past 5 years, we reinvented a lot of concepts that already existed to the point where we actually didn't invent anything new. We've effectively deconstructed a central bank and imposed all of its parts onto a blockchain for anybody to use as public infrastructure. And this is all based around the core philosophy that money is debt. And money and debt are an inseparable concept. Money is always created as a debt to somebody else. It's always been this way, and it always will be this way. So we had to found our entire project on that. And I often refer to Maker as a decentralized central bank, which sounds oxymoronic, but it really is true, because while Maker prints money like a commercial bank, it also has to maintain monetary policy to control the peg of DAI, which is basically just like central bank's inflation targeting based on interest rates. So before we go into the details of the system, I just want to reintroduce you to our 3 core components. You have DAI. That is our decentralized stablecoin. And DAI is outputted by vaults. Now, vaults are a smart contract. They control the creation and destruction of DAI. Keep in mind that every DAI is created as a loan, but the people that create DAI do not wish to hold DAI. The people that create DAI are looking for leverage or liquidity, and they are immediate sellers of DAI to stability seekers. Finally, we have MKR. This is the token that controls the parameters of vaults. So you can kind of think of this as a ascending system where Maker lets vaults know how much DAI it can create and destroy. And then because of this, DAI is outputted and remains stable because the vaults are managing the supply via the monetary policy of the Maker holders. So let's talk about DAI itself. DAI is the world's first decentralized stablecoin. You know, obviously there were some attempts at decentralized stablecoins prior to this. I would argue, you know, the argument can become semantic at points, but I would say that its predecessor, BitUSD, was not really decentralized because it was on BitShares, and BitShares was not using a truly decentralized consensus mechanism. So in that context, DAI really is the world's first decentralized stablecoin. But getting away from semantics, it's actually very important that it's decentralized, because this gives it all of the favorable properties and innovation that we're looking for in cryptocurrency. If you compare DAI to its competitors like Tether or USDC, you know, we don't believe that those tokens are truly innovating. They're just expanding the reach of the current financial system. And in that context, they're not really peer-to-peer. They're cash, but they're not peer-to-peer. DAI, as far as we can tell, is the only peer-to-peer cash. And as we'll see later in the presentation, this decentralization lets us do some key things that other stablecoins or even commercial banks can't do, which is offer a higher rate of interest on deposits and charge a lower rate of interest on loans. So, when people ask who our competitors are, really it's commercial banks. We're trying to fulfill the original Bitcoin vision, which was that Satoshi wanted to disintermediate politics and banking. I believe the fallacy that he bought into was that money is printed by central banks, where central banks facilitate the printing of commercial money, but it's really the commercial banks that are actually performing the function. So Bitcoin, yes, it's a great check on commercial banks, but on central banks, but it's not a great check on commercial banks who will continue to print money and then have to be bailed out by central banks. So Dai is actually the first hybrid where you're combining the central and commercial banking function. So as I kind of went into the prior slide, you can't have value without scarcity, but you also can't have stability without dynamic supply. This is where the credit theory of money comes in, but this is also where collateral comes in, because any money is only as good as the collateral backing it. Now, Dai has seen some competitors over the past 2 years who have tried to take a shortcut. I'm sure you all remember Basecoin a year ago. They've since shut down. We never thought that was going to work because that was uncollateralized. And you can manage the supply all you want. Without collateral, there's no intrinsic value to the currency. So people will not buy that. Now we have some new competitors that are trying to make the collateral a more volatile asset. I mean, we have Ether, and that's not even the greatest collateral. We have to expand into legacy collateral types to really make a sustainable system. But, these new competitors, that would be like lending against Tesla stock as the core of the US economy. So let's talk about how Dai gets created in the first place. And if you're familiar with the legacy financial system, you can almost think of vaults like repo facilities without an end date. So these are the smart contracts that are responsible for creating and destroying Dai. The way it works is that you come to us with an asset. In this example, we use Ether, and you're able to mint a fraction of the value of that asset in Dai. If the value of your asset that you deposited as collateral goes down relative to your loan, and it crosses what we call the collateralization ratio, which is just the inverse of a loan to value, then your collateral is liquidated via an auction onto the blockchain. Now, while you have this Dai outstanding, you accrue what we call the stability fee. And the stability fee is similar to an interest rate. It is what's paid to the maker holders for underwriting your loan. And you also will have various parameters. You'll have a collateralization ratio, which tells you how much Dai you can borrow against the value of the asset and must maintain. You'll have a debt ceiling, which tells you how much Dai can be borrowed in aggregate against the asset. And finally, you'll have a liquidation penalty, which will tell you the punishment for letting a liquidation occur in the system. But let's break down what a vault really does. So it can actually be broken down into 6 steps, only 4 of which most users will ever interact with. So the contract accepts a user's pledged collateral. And keep in mind, this pledged collateral can now, in Multi Collateral Dai, be anything. It could be Ether, could be a ERC20 version of Bitcoin, or it could be an ERC20 token that's representing a real-world asset like a mortgage or an invoice. It'll check the parameters for lending against a specific collateral. Those parameters are set by maker holders, and we'll talk about that in a bit. It then allows the user, and this is the true innovation of our system and why it's so important to be decentralized, it allows the user to create a Dai facility against the collateral. Translation, the user is printing their own money. And then if the user pays back their loan with the stability fee, the smart contract will release the collateral, and it will send that stability fee to a burner contract that will be used to purchase MKR tokens and buy them back. But if the loan goes below a certain threshold, the smart contract will liquidate your collateral for Dai up to the value of the loan outstanding. And it will destroy this Dai to maintain the supply relative to collateral ratio. And of course, in the event of a liquidation where the loan is under collateralized, this is where the underwriting function comes in. The MKR token will be diluted to the point where the system is recapitalized. And I'll talk about this a little on the maker slide, because that's actually really important and part of the core philosophy of the system. So now, just looking at an example, this is a live screenshot I took yesterday of a CDP that I have. I deposited 0.5 ETH. I generated 20 DAI against it. And my collateralization ratio, because of the value of Ether at the time, was 435%. So because my liquidation ratio is 150%, I have a lot of cushion. What this translates to is effectively I'll be margin called at $60 if Ether trades there. And if that happens, I will pay a 13% penalty on my collateral for letting a liquidation occur. If not, I will continue to accrue a 4% stability fee. Now, this is a screenshot from the old system, because fortunately I have not been liquidated yet since Monday. But this is what would happen if your CDP is liquidated. So it's a very simple system. It just alerts you, your CDP was liquidated. You didn't pay back your DAI. You let the collateral go below the value. And effectively, the 13% penalty was charged to me and deducted from my collateral. So let's talk about Maker, because they're the ones that control this whole system. The Maker governors in the new system have 3 core roles. They set the parameters of vaults, and those parameters specifically are the stability fee, the collateralization ratio, and the debt ceiling. They base this off of what we call open and scientific governance. So we have a forum where all Maker holders can congregate, and they are able to then discuss the pricing of risk relative to specific collateral. And the reason they want to do this is because of this final function that they have, which is underwriting DAI. Every loan that's outstanding, the Maker holders not only are receiving the benefits of the stability fee, but are truly underwriting. So, and this goes back to our core philosophy, where if you look at the legacy banking system, if the bank screws up, basically the entire economy pays, because they have to get bailed out, and it's done through inflation. We can't promise that that won't happen in our system. Like I said, we didn't invent anything new. We've just made it more transparent and efficient by putting it on the blockchain. But what we can do by doing that is to align incentives in a better way. So in this context, sure, you can have Maker holders input bad collateral and the system can be under collateralized and suffer from a black swan event. But DAI holders will never take a haircut until Maker holders are completely and programmatically destroyed. So at the very least, we have better incentives in the legacy banking system. And the final thing that they do, and this is actually the part of the new system that I'm most excited about, is set the DAI savings rate. And that's an interest rate that gets passed directly from the stability fee to DAI holders. And I'll talk about that in a minute. So we just launched on Monday. This was 5 years in the making. It was a massive undertaking. Like I said, we have 105 employees, and all of them have been working overtime to get this out. But one of the core features of Multi Collateral Dai is something called the DAI savings rate. And the DAI savings rate, in my opinion, is our killer app and a truly innovative product. Its economic purpose in the system is to be the primary monetary policy tool to balance supply and demand. So let's say that, let's first use an example of the Federal Reserve and say that they're targeting 2% inflation. So the Fed sees that relative to a basket of goods and services, the dollar is inflating faster than they want it to. It's about 3%. What they can do is they can raise interest rates to make money tighter. We can do the same thing, but we can also raise the rate on deposits, much like they can as well. So the analog or the analogy for what you'd see in our system is, instead of looking at a basket of goods and services, we're looking at the price of the dollar itself relative to DAI. So if we see inflation in DAI, meaning that it starts trading below $1, we can raise stability fees on CDPs to discourage, vaults to discourage borrowing, while simultaneously raising the interest that gets paid to DAI holders for doing nothing, just sitting there and holding DAI. And what's unique about this is that there's no liquidity trade-off. And this is not even something that you see in the legacy economy. Because keep in mind, when you go to a commercial bank, technically they're lending out your money. Even if that's not how the system is happening in practice, there are liquidity constraints on your account because it is fractional reserve. In this system, there is no additional lending of your currency. When DAI is created by a vault owner and it goes to its final stability-seeking holder, they can deposit it into the Dai savings rate contract, and they just immediately begin accruing interest from vaults themselves, that there's no secondary lending market, which means that there's no additional counterparty risk from holding Dai itself. It's the risk-free rate of our system. And what I think is most important is that it's completely composable. It's a smart contract variable. So any of our 410 partners can write this directly into their smart contracts and create a new revenue stream. We think it's specifically exciting for exchanges because it allows crypto exchanges to have an entirely new revenue model that's more similar to a legacy business, which is net interest margin. They can pass a portion of the Dai savings rate, which, by the way, will almost always be higher than LIBOR, which makes it especially exciting because it means that it'll usually be higher than a high yield savings account. Right now, we've kicked it off with 2%, but I expect it to change frequently. Basically, if you're an exchange, you can give, let's say, 1% back to your Dai holders on the exchange, and then pocket 1% for yourself as a new revenue stream. The other thing that's new in Multi Collateral Dai, as is indicated by the name, is, of course, new collateral types. And this is really important because, like we said earlier, a stablecoin or any currency is only as good as the collateral backing it. And in this context, we want as diversified as a collateral portfolio as possible. Now, like I said, it's done through decentralized governance. The two places that you can go to do this if you are a maker holder are forum.makerdao.com to participate in the risk pricing discussions, and then vote.makerdao.com, where the votes are taking place, where Maker is actually used to enter assets into the system in a programmatic fashion. Now, the Maker holders entered one new collateral type so far. It's quite correlated to Ether, so it doesn't really improve diversification that much, but it is exciting to see a new collateral type after 2 years. So the first one that we have is Basic Attention Token. They've given this the parameters of a 4% stability fee, I believe a 150% collateralization ratio, much like Ether, and a 3 million Dai debt ceiling. So once there's been 3 million Dai borrowed against Basic Attention Token, the Maker holders will have to vote to raise that debt ceiling before any new Dai can be generated against it. But what's more exciting for me is what's on the roadmap. We've been spending the last 6 months doing pilots with legacy originators and traders to try and see what it would be like to get real world assets into the system. And the outcome of those pilots was pretty promising. We did 6. We had a treasury securities trader, a large commodities trader out of Asia, an invoice factor, a synthetic receivables creator. That one's actually public. They released a blog about it. They're called Paperchain. And a short-term mortgage originator and a long-term mortgage originator. And of those 6, the only ones that really can't use our system economically are the treasury traders and the commodity traders. And that's because they have access to repo facilities at LIBOR. And because the Dai savings rate will almost always be above LIBOR, we can't compete with that. But for everybody else, their hypothetical borrowing rate, when we mocked what a vault would look like for them, was better than what they could get in the legacy economy at a bank. So we're very excited about entering new collateral, and we think that in due time, we're going to see a very diversified portfolio develop that backs Dai. So just to give you an overview of where we are, over the past 2 years, we've had 450 million Dai of cumulative loans issued, and there's currently about 104 million Dai outstanding. And keep in mind, every Dai is a loan, so that's equivalent to loans outstanding. We have, I didn't update this yet, but we have about 410 live integrations for Dai and vaults. There's 132 in progress, and we have 327 tentative commitments. To address where we're going from here, what our growth roadmap looks like, we break down our growth into 4 functions, and these map to the functions of money because that's our product. So I actually want to begin with the standard of deferred payment. This is the one that most people forget, and this is the one that I especially believe Bitcoin has forgotten. And this is the concept that you have to be able to denominate your debts in a currency in order for it to be true money. This is where, as I just discussed, we need to get as much real-world collateral in the system as possible, because at scale, the only way to really make a meaningful difference in people's lives is to be able to give them liquidity on the assets that they already have. We can't expect them to go to cryptocurrency exchanges and buy Ether in order to get cheap loans. That doesn't really make much sense. We have to let them take out loans against their houses and businesses. But the unique thing about DAI versus other stablecoins is that it's implicitly a standard of deferred payment. So every DAI begins its life and ends its life as debt. So because of that, we can cross this right off and say that we always meet that function of money. Now, in terms of the demand side, we map that to the store of value, unit of account, and medium of exchange. And here we need to take a particular strategy because all of these are a cycle and flow into each other. You can't really build these simultaneously. You have to focus on one and build it to the point where the next one becomes viable. So I'll contrast us with something like Libra, which is probably going to be our biggest competitor. So Libra has incredible distribution networks, but they also lack the ability to pass a high rate of interest onto their token holders. Even if they could legally pass interest onto their token holders, which I don't think they can because they're not going to be decentralized, they're going to be constrained by LIBOR because they're just piggybacking off of the legacy banking system, much like our other stablecoin competitors. So it'd be hard to imagine that Libra starts off by encouraging people to hold Libra tokens as a store of value. Because of their distribution channels and the ability to enforce fungibility across the network, they'll likely start as a medium of exchange and then hope that people begin pricing items in Libra tokens, which would be meeting the unit of account, and finally flow into the store of value. We have to take it a little bit differently. So DAI's core advantage is that it's decentralized. Because it's decentralized, it can offer these high rates of interest in the DAI savings rate contract. So we're starting with store of value. Now, there's a couple markets that we've already seen a lot of success in this vertical with. DAI's most popular market after the United States is actually Argentina. In Argentina, DAI trades at a 20% premium right now. And this is in comparison to some other assets in Argentina, like their blue dollar, which trades at $1.09. And Bitcoin, which trades at $1.09 as well. So if you think about that, you have three numbers that emerged from that equation. You have the price of stability, which is the price of the blue dollar, and the blue dollar can't leave the country. You have the price of capital flight, which is Bitcoin, but it's not stable. And then you have DAI, which can both facilitate capital flight and is stable. And that, as you can see, is greater than the sum of its parts due to the 20% premium. But now that we've kind of expanded into Latin America and we're seeing traction there, that's only viable because of those high inflation rates. We also want to be competitive in legacy economies where we can compete on interest to savers. So I think over the next year, you're going to see us pitching the DAI savings rate to a lot of legacy businesses. So now, once we're a store of value and a good store of value, that means that market makers will be willing to hold more DAI in their books because it'll produce the highest rate of interest for their idle inventory. Once market makers are trading DAI more than they are today, we can hopefully become a medium of exchange. And our first vertical that we'd like to go into via medium of exchange is remittance, because right now it's very difficult, as you know, to transact overseas or over borders. And this is because the SWIFT system is very inefficient, but the SWIFT system is very liquid. The correspondent banking mechanism that's enforced by central banks is very effective because it pools all of the liquidity. But if we can begin to compete with that liquidity even on a small scale, we believe that'll be a self-fulfilling prophecy where we can start to eventually do large-scale cross-border transactions. And then finally, if we can be a store of value and a medium of exchange, we can hit the holy grail, which is the unit of account, which is where you would actually see people pricing items in DAI and not in dollars. And I will leave that to pipe dreams for the moment. But I do want to note that on this specific vertical, we have a bit of a growth hack embedded. And that's, we're the de facto stablecoin on the Ethereum blockchain. Sure, other stablecoins can have a higher market cap because they can easily be created and redeemed on exchanges, and they're used for trading. But if you're going to look at decentralized applications, DAI is the only stablecoin being used pretty much. And we're going to be seeing Augur integrate DAI in the near future. That's pretty exciting. And we also, on our own roadmap, have what we call synthetic assets. This is where we intend to replicate the entire multi-collateral system, except instead of collateralizing with a diversified pool of volatile assets to produce one stable asset, we use the one stable asset that we have, which is DAI, to collateralize any volatile asset. So the first ones we're going to be targeting are Euro Dai, Chinese Yuan Dai, Pound Dai, but then we can even go into more esoteric products. And keep in mind that the system's completely decentralized and it's actually the user that's generating the synthetic asset. So there really is no limit to what can be created as long as the user has Dai to collateralize the loan of synthetics. So that concludes the presentation. I hope you enjoyed it, and I'm happy to take questions.
Terrific. Thanks so much, Greg. That was great. Lots of good info in that, and we're excited to kind of dig into that a little bit deeper here in the Q&A. Just as a reminder, everyone on the line, if you have a question, feel free to submit it. Thank you to those of you who have already submitted questions. If you submit a question, your question will only be visible to Greg and myself, so no worries about that being displayed to other attendees. So, I guess maybe we can kind of kick this off by going a little bit deeper into the most recent upgrade and talking about some of the changes that have been made. So one of the, aside from the integration of multi-collateral Dai, which I think is relatively straightforward, right? I think it fulfills this bigger vision for the protocol, an overall greater offering for people, and also kind of an attempt to diversify risk over time. Could you kind of talk a little bit about the thought behind the Dai savings rate? And, correct me if I'm wrong, I think that this integration kind of provides the protocol a new lever to pull to ensure the stability of Dai. As I understood it in the past, the protocol primarily relied on adjusting the stability fee as a means of kind of maintaining that Dai stability.
Yeah. So in the old version of the protocol, the single collateral system, the only monetary policy instrument that we had was the stability fee. So what this meant was that if we saw Dai inflating versus the peg or deflating versus the peg, all we could do was incentivize borrowing by lowering the stability fee or disincentivize borrowing by raising it. This was an extremely blunt instrument, and it led to a lot of volatility in the stability fee itself. So when we launched to seed the system, we had artificially low rates. They were 50 basis points. In a year, that rose to 21.5 basis points because the product became so popular. And because we weren't able to pass any of that interest onto the Dai holders, you saw that huge fluctuation. If we had the Dai savings rate, we likely would have been able to have much lower volatility in the borrowing rates. Does that answer the question?
Yeah, totally. I think it's, I just wanted to drive the point home because I think that it's a really, not only great offering from a user perspective, but for ensuring the stability and success of the protocol as well. It's just a nice extra tool and a really cool innovation on top of the support for multi-collateral assets. That said too, maybe we can, we talked about how basic attention token is the only current additional supported collateral. Maybe we could just briefly talk a little bit about this process of new tokens being suggested. How exactly does the community kind of come to a sense as to how the security parameters or the various different risk parameters should be set, and that overall process of going from making a proposal to kind of integrating it completely into the protocol.
Yeah, and I would say keep in mind that this process is still very fluid and being developed, and is always subject to change because it's not something that the foundation actually has control over. We can make suggestions, but the foundation doesn't vote, and this is a process that's designed and implemented by the maker holders themselves. So for BAT specifically, the way it was entered, there was a poll taken within our forums. There were 7 tokens in the poll, and that was based on, it was a bit of technological debt because those tokens had already had test adapters built during the development process. But also it was just based on community feedback and what tokens they were talking about the most. So there was a poll, and people then signaled with their maker tokens which assets they were most interested in. And I believe they picked 3. And then they put those 3 through a more rigorous risk analysis process, of which the only one they felt met their qualifications was BAT. So those 3 again went through another signaling process. But there's really 6 things that the maker holders are looking for when they risk analyze an asset. The first is a financial risk analysis. This is where they need some sort of risk team to put parameters around it and publish the results of this finding so that they understand why those risk parameters exist. The second is a legal risk analysis, where they need to understand the legality of the token and make sure that it's not a security or something, or if it is a security, that it's properly registered. The third is a technical risk analysis. This is where they'll have auditors review the smart contracts of the token itself. If it's an ERC20 token, this is generally standardized, so it's not a big deal. But if it's a custom token, I believe that they'll often want the writers of the token or somebody to provide formal verification of the code. The fourth is the Oracle software. This is so that they know that they'll have a reliable price oracle that's just as equally decentralized to what we have running for Ether, which is not particularly decentralized, but is at least what we think is good enough for the time being. Then they need to have a adapter contract. An adapter contract is what lets the token be, I'll use the word physically, almost ironically here, but physically entered into the protocol. And this also should be formally verified. Again, if it's an ERC20, that's already written and standardized. And then finally, an auction contract, which allows the token to be auctioned off. Again, standardized for ERC20, but where you can imagine this getting different is if there's security tokens in the protocol, you're going to need to manage the whitelisted participants that are allowed to bid. So that would have to be a custom auction contract, and that too will have to be formally verified and audited before it's allowed in the system.
Got it. So needless to say, there is a comprehensive review that's kind of undertaken amongst the community.
Yeah, and it's only getting more comprehensive. They're really, I have to say, I'm very impressed with our community because they're coming together free of charge, just out of the collective interest of holding maker tokens to develop very thorough processes for entering new assets.
Totally. Gotta love that element of the decentralized world. Maybe that's a good segue too to ask one of the questions that I think is on the minds of a lot of people, and I'm sure there's a variety of issues as it relates to this, but the integration of Bitcoin as a collateral. I know that there's a few different ERC20 denominated BTC tokens. There's wrapped BTC and TBTC. I think that wrapped BTC, for example, is a little bit of an issue because of the custodial element to it, but we see projects like TBTC trying to really bring Bitcoin onto the Ethereum blockchain. That said, have there been any kind of discussions amongst the community or thoughts about getting to this other kind of, I guess, big milestone people would like to call it?
Yeah, the community is very eager to get Bitcoin in the protocol. I mean, mainly just because there's so much demand for it. And also because, because of its market cap and liquidity, Bitcoin probably makes better collateral than Ether at this point in time. If the system could have been built on Bitcoin, I think it would have been, but because Bitcoin doesn't have the advanced level of smart contract functionality, it was built on Ethereum. But they desperately want to get Bitcoin into the protocol, mainly for two reasons. One, they want to borrow against it themselves, and two, because I think they see the kind of revenue that'll bring in for them. But as for what's being discussed, basically the only two out there that I've seen are WBTC and TBTC, like you referenced. The community definitely has a preference for TBTC over WBTC, but they also are developing this philosophy that no asset should be turned away from the protocol. The only thing that you should have is different parameters for those assets. So if you want to let in WBTC, but you don't trust the custodial aspect, you would just put a lower debt ceiling so it's not a systemically large portion of the portfolio, and you'd have very high risk parameters so that the maker holders can be hopefully fully compensated with stability fees in exchange for underwriting that risk. Got it.
And then the other side of that, I guess, too, is a question as it relates to the integration of regulated assets. If there's been kind of, I know that we're taking it one step at a time here, and that we've only kind of brought on a new collateral just as of recently. But any kind of thoughts or things that we should know as it relates to bringing on regulated assets, and does the community see tokenized securities impeding on decentralization in any capacity?
Yeah, I think the community is a little bit divided on this issue. That some people are very strongly against any sort of, I'll call them real world. I know that's not the correct term, but non-digitally native assets getting into the protocol. I think the foundation is very much for these assets being in the protocol. I think if you do your research, it's just a matter of pragmatism. There's really not that many assets that can exist in an entirely decentralized capacity. And if you want to really meet the vision of what MakerDAO set out to do, which is to basically fulfill the original vision of Bitcoin, you can't limit your collateral pool to Bitcoin. that doesn't make any sense. If the protocol exists because Bitcoin's not meeting the goals that it originally set out to do, then Bitcoin can't be your only collateral. And I think, from a philosophical standpoint, if you think, let's imagine this protocol existing truly at scale, where DAI is now the de facto currency of the planet. You can't have people collateralizing against things that they don't already own. The whole concept of banking is that you're able to create liquidity and money against assets that already exist or will exist. So, I think it just ignores some basic economic tenets to think that we could ever really survive without those assets. Because keep in mind, the supply of DAI will be limited by to a fraction of the market cap of decentralized collateral. But the utility of DAI is not limited by anything. It's useful to everybody, especially when it has a high DSR.
Right, and those are all super great points and things that are totally need to be considered as it relates to bringing on tokenized securities and whatnot.
Yeah, actually, I'll just caveat that. This is kind of the beauty of the system. While I feel that way, it doesn't matter. I don't really have a say. It's up to the maker holders in the community what actually happens.
That's true. Yeah, great point. Very, very true. And I guess going back to that, you kind of joked about let's assume a world where DAI takes over. Are there any kind of concerns or thoughts about Ethereum's ability to scale it? I think that some people might look at Maker being deployed on Ethereum as a bit of a double-edged sword. And I don't know if there's any kind of talks about the importance of interoperability across chains for Maker or DAI, but any kind of thoughts on that front as well?
Yeah, well, like I said, the system was founded on BitShares and moved to Ethereum at a very early date. We have always been blockchain agnostic. We would like DAI to be the de facto stablecoin of every blockchain. So, in that context, I don't think that, we obviously love Ethereum. We think it's the best solution right now. But if they can't meet their scaling goals, then we are going to make the pragmatic decisions, not the philosophical ones. So I think that I personally think Ethereum is going to scale, especially for our needs. We don't have a throughput heavy application. The needs of the Maker protocol are actually security based. So we really need two things. We need advanced smart contract functionality, which Ethereum has, and the best security. So if there's ever a blockchain that has better security than Ethereum with equivalent smart contract functionality, then I think you'd have, and also a equivalent size of community and network effect, which is probably going to be the hardest one to break, then I think you'd have an argument that we shouldn't be on Ethereum. But for the time being, I don't see any alternative to building on Ethereum.
Makes sense. Yeah, it's I'm glad that you kind of touched on that philosophy. I think that's important that you highlight that, and people are cognizant of the community really kind of being found on that ability of just kind of, I don't want to say pursuing the mission, but sticking true to the overall goal. So I'm glad that you brought that up. And maybe we can kind of shift discussions over to the governance side of things. I think we've spent a lot of time talking about all the great, new features and abilities and new collateral that will kind of come to this protocol, and how the protocol itself will, if you will, make sure that those become a reality. But we kind of really haven't talked on, how does this governance system work, and how do we make sure that the wheels kind of keep turning here? I think that, if let's say I'm a skeptic, I think that one of the things that I would point out and say is Maker continues or has in the past had challenges with voter turnout. I do think that there, some of the bigger issues in the community certainly get support from holders of MKR. I think a great example was just this most recent Multi Collateral Dai upgrade. In which case we saw A16Z come in and place their vote. But there's still kind of these challenges of getting maximal output from voters and contributing from the community. So have there been any kind of talks about how to really ensure that the holders of Maker are incentivized and really have serious skin in the game to ensure that, you know, if the foundation decides one day to kind of take their hands off the steering wheel, so to speak, that this ship can kind of, you know, drive itself?
Yeah, actually, I'm going to work backwards with everything you just said. So first of all, the foundation is absolutely going to take its hands off the steering wheel. We have a 3-year plan at which the end of it, the foundation is going to be wound down. So the entity I work for today, if everything goes according to plan, will not exist in a couple of years. In terms of having skin in the game, every Maker holder has skin in the game, whether they vote or not. They are always underwriting the loans. And in that context, you know, there's definitely some disagreement on this point, but personally, I feel like it's a feature, not a bug, that we have low voter turnout right now. Because by not voting, you're effectively delegating your vote to everyone who does. Because you're still in the liquidity pool. You will still be diluted if those people that are voting input bad assets at bad parameters and cause bad debt. So, you know, what we've seen, and this is from experience, is that voter turnout is not necessarily important, but community turnout is very important, because the conversations that happen on our forums and in the community are what drive votes, not the other way around. Votes don't drive community participation and conversation. So what we're seeing is that you have a small number of very dedicated holders that really know what they're doing. And, you know, sometimes we don't even know who they are, but they are excellent at pricing risk and establishing the scientific governance framework. And I'll get into that in a second too. But they're presumably the ones that are also voting. And then people like Andreessen, they, you know, by voting with such a little portion of their stake, they're effectively saying, yeah, you know what, we like what we see. We're carefully watching what the community's saying. We retain our ability to vote big. But right now, we like the way it's going, and we're going to delegate our votes to the people that know what they're doing.
A feature, not a bug. That is beautifully put, and totally makes sense.
And possibly controversial, I'll add that, because I don't even know if the rest of the foundation would agree with me on that, because I know there are some efforts to improve voter turnout.
If it wasn't controversial, it wouldn't be crypto, right? I mean,
yeah.
Cool. And on that note, so taking a step back, if we look at the MKR token, the value is to it is kind of twofold, right? You have this ability to participate in the governance and ensure that, you know, going forward, the project stays afloat, it evolves like you believe it should, and keeps the wheels turning. And then second, correct me if I'm wrong, it's used for bidding in Dai surplus auctions, which is essentially when the Maker protocol balance sheet hits a certain level of Dai that comes sourced from stability fees from collateralized debt positions. You know, people can use that MKR to bid for Dai. So in a sense, there's, you know, the more popular that the Dai becomes integrated and widely used and demanded, your MKR tokens not only help to kind of make sure that you maintain that development and success, but also that you know, more MKR will be burned in my purchasing power, essentially, of Dai from my MKR token will go up. Is that correct?
Yeah, that's totally correct. And it's a very simple philosophy. It's just if the Maker holders are doing a good job governing, they can accrue the maximum amount of stability fees. The amount they can accrue is what they charge to the vault owners minus the Dai savings rate and minus their operating costs, which will likely be majority Oracle based. And if they're doing a really good job and being conservative, they can maximize that number over a long period of time, and they could have consistent buybacks of the token. And yeah, just to go into the auction you referenced, the way that works is vaults accrue stability fees in Dai. That Dai is then auctioned off for MKR, and that MKR is burned. But it's also important to note the inverse of this, where if they put in bad debt and there's not enough collateral to cover it, not only did they not accrue the stability fee, but the Maker token, through a similar auction mechanism, is minted for Dai to recapitalize the system.
Understood. Yeah, you know, I think the MKR concept is really interesting, and I think that if you kind of take a look back, or you take a step back, you can kind of this might be far out there. You can kind of look at this as like the ultimate HODL game, if you will, right? And what I guess I mean by that is that since the stability fee is denominated in DAI, and MKRs use it at a later date to bid for DAI, the price itself of Maker is kind of somewhat, I want to say irrelevant, but not completely. Let's say, for example, I am the very last MKR token holder, right? That means I can essentially bid as little as I'd like for the excess DAI with my MKR token, and thereby, in a sense, kind of set the price of MKR, if you will. Does that kind of make sense? Is that something that the community's ever kind of perceived the MKR token as?
Yeah, that makes sense. I think the more important thing about MKR though is that its market cap is effectively an insurance pool. So if you're thinking about using a competing system, that's one of the factors that you're going to want to take into account, because you're going to say, well, if this decentralized stablecoin fit, and we don't have a competing system yet, but I'm assuming in the near future we will. You might look at it and say, okay, well, they have similar liquidity, similar concepts, but this one's backed by $600 million of insurance. So I would rather use this one than one with no insurance.
Got it. And so the people who are participating in these auctions and checking the vaults and whatnot, these are separate participants of the protocol, right? These are like keepers and whatnot. Is that correct?
So the ones that are participating in the DAI surplus auctions, those are maker holders. Those are people that want a decentralized way of liquidating their maker tokens for DAI. But people who bid on collateral, we call those keepers. And the way that works is that, let's say you have a vault that is below its collateralization ratio. The vault can be bitten, which is a smart contract function call that's called by a keeper. Keeper can be anybody. It is a very competitive system though, so it's not anybody. It's very highly specialized bots that play gas fee games in order to get filled, because they get a significant discount on the collateral in the auction mechanism.
Got it. Thank you for clarifying that. And then maybe we can kind of move a little bit onto the regulatory front. Everyone's favorite topic of discussion. You brought up Libra. I'm really kind of curious, as the community's kind of sat from afar, and everyone else in the community, or in the industry rather, has watched Libra go through the gauntlet, if you will. Has the community kind of made any notes or kind of come to any realizations about how to navigate or not navigate through these existing regulatory waters?
Yeah, well, actually, the backlash against Libra in DC is one of the better things that has happened to us, in my opinion, because we contrast just so nicely with them. We're kind of like the anti-Libra when you think about it. So to give you an overview of Libra, for those who don't know, they are effectively trying to replace commercial banks with unregulated tech companies. So if you think about the way that money is created, you have a central bank that delegates the risk pricing and printing function to commercial banks, which then interfaces with the individual borrower. Libra is not innovating on that construct at all. They are actually taking the same concept, but they're making Libra Network the central bank. They're making tech companies the commercial banks, and then those tech companies will interface with the borrowers. The sole difference being that those tech companies are unregulated and don't have to follow any money transmission or banking laws, which, if you've seen the way they manage their social platforms, will be a complete nightmare. So in contrast, the Maker protocol eliminates the commercial banks completely. It allows the end user to go directly to the central bank protocol. So at least from a regulatory perspective, we think that we are really helping everybody, because regulators, even though they regulate commercial banks, they don't necessarily like them or want to do that. If they could eliminate them from the picture and put the power of printing money in the hands of the individual, I think that's a net win for everybody.
Totally agreed. And just on that note, kind of sticking to Libra, these tech companies trying to make their imprint. Let's say I'm a skeptic again, right? And I say, what's kind of the point of something like DAI? I don't need DAI. I've got Libra, or I've got these nation state stable coins. What would kind of be the response to that?
Well, there's two routes you can go down. do you have a philosophical stance on the long-term viability of your money? If you do, then you're going to want to hold Dai, because the Libra dollars are just going to get infested with politics like our current dollars have. I mean, that's been our philosophy from day one. The problem with money is politics. It's not the construct by which it's created. So if you're going to replace those commercial banks with extremely political tech companies, then you're basically just asking to have your bank account frozen. But if you don't care about that, which actually I presume most people strangely won't, then our pitch to you is that you can get a higher rate of interest. You can have absolutely no liquidity constraints and get a higher rate of interest than you can in a high yield savings account.
Got it. Yeah. So we're coming up on the hour here, but maybe we can just push through a few more questions. I think one of the other things that people would appreciate understanding is we've gone over kind of a lot of the features, the integration of the protocol, how it's run and whatnot. But maybe we can kind of talk a little bit about the security features that are in place. Maybe we can talk a little bit about emergency shutdown and the use of oracles and kind of how the system is structured such that a black swan event, or you come across a group of people trying to hack the protocol. What are kind of some of those lines of defenses that are currently established?
Yeah, and I'll caveat this with, it took us 5 years to build this system. We at least think we've thought of everything. So we've done a lot of thought experiments on this subject. Basically right now, the biggest weakness in the system is the reliance on centralized price feeds. This means that in order to get the price of $1 versus ETH, we need to rely on exchanges which are not on the blockchain because they're dealing with real world assets like USD. And to get that price feed information into the system, we need to trust somebody. And to this point, there's no decentralized oracle that exists right now. So to mitigate this issue, we have the most decentralized system we know how to run. There's actually a great blog about it that was recently put out, but we have a whole construct where we have these trusted nodes. Half of them are called light feeds, which are public entities. Half of them are called dark feeds, which are anonymous entities. And they all input prices to a mesh network that's built on the secure scuttlebutt protocol, which is a JavaScript mesh network, where they only need to be able to reach one node to successfully get their price into the system. You may think it's an issue that they're all trusted, but yeah, it's going to be pretty hard to get all 20 of them to collude, especially when you don't know who half of them are. But even if you could get all 20 of them to collude, or even if you got some of them to collude, the prices are always medianized, so any outlier is immediately thrown out. And then let's say you did somehow compromise all of the 20 oracles. Let's say you're a state actor. The worst you can do to the system is cause friction, because all of our prices are entered with a 1 hour delay. Now, in that 1 hour, a 5% quorum of maker token votes can trigger what we call an emergency shutdown. This is a global redemption mechanism. This means that as of the moment it's triggered, or the block in which it's triggered, every Dai that you hold is now redeemable for $1 of collateral. And because all of that collateral is on the blockchain, you have that redemption function not intermediated by any centralized entity. And it also allows us to pretty gracefully reinstate the system, because much like we're doing the migration now, if this emergency shutdown was to happen, I say it would only cause friction because you can immediately transfer that Dai over to a new system. The trade-off would be that that Dai is a new contract address, and we'd need to upgrade the Dai token with all of our partners, but that would be the maximum amount of friction. There is no circumstance where you could take everybody's money.
Yeah, certainly it's been, to your point, it's certainly been well thought out, and there's a lot of moving parts. And I think that there's a good set of safety layers and checks and balances in place to prevent anything serious from going awry. So maybe I can just throw one last question your way, and this is a little bit more of a bigger picture philosophical question, or, is there anything that's, you feel like in the next several years you'll look back and kind of identify as, one of the bigger or biggest challenges, and really kind of look at it as a defining moment? And that can be with respect to, broader crypto industry or maker.
Oh yeah, I mean that's an easy one, and I hope I didn't hand wave it away in this presentation. But The decentralized governance function is really hard. It's the trade-off we make in order to operate. You know, if we were centralized, we wouldn't be able to operate. We'd be pigeonholed right into the existing financial system, and we'd just be an extension of banking APIs. But because we're decentralized, we can do all of this cool stuff, yet that decentralization comes at a cost, and that is the cost of coordinating a decentralized group of governors, which, as you know, I mean, even though it's been working for 2 years with a single collateral system, now that we're going to try to scale, the real test lies ahead of us, not behind us.
Well put. Well put. Greg, this was awesome. It's really great to bring you on. I'm super excited to kind of see what's to come in 2020 for Maker, and can't thank you enough for jumping on. And to everyone attending, thank you for joining us as well. We hope you found this of value. Feel free to reach out to the Kraken Intelligence team if you have any questions, comments, or concerns. We can be reached at intel@kraken.com. And Greg, if people want to get a hold of you or learn a little bit more about Maker, where can they go to?
Yeah, please. Anyone feel free to reach out. I'm always available. My email address is greg@makerdao.com. That's Greg with 1G, G-R-E-G. And if you would like to join our community, which we'd love to have you, there's really 2 places to do it. If you're interested in the risk pricing discussions, you can go to forum.makerdao.com. If you're interested in just being a general community member and not so interested in the collateral onboarding process, you could just go to chat.makerdao.com.
Terrific. Thanks again, Greg. This was great. And everyone else, hope you have a great rest of your day.
Thank you for having me. Appreciate it.
Of course. Till next time. See ya.